very good afternoon to all. Most respected the senior and vibrant Central Council member, CA Babu Abhraham Kallivayal sir from Cochin. The faculty and another vibrant personality and the Central Council member from Chennai, CA MP Vijayakukar sir. Secretary of Kannur branch, CA Shivaprasad sir. Vice Chairman of Kannur branch, CA Vijayakukar, illustrious past chairman of Kannur branch, members of the profession, and my dear other participants. Today, all we are extremely delighted and excited, and I could say that this is one of the golden moments in the history of Kannur branch, with the two senior Central Council members on the same platform of the Kannur branch for a CP's program. That too in the Corona season. As far as the Babu sir is concerned, I have nothing more to elaborate, since he is the backbone of the Kannur branch and is always traveling through each and every members, especially in Kerala, and is a passionate professional and is a real hard worker. And he is the, all of us knows that he is the chairman of Board of Studies of ICAI during 2016-17 and is the present chairman of the Expert Advisory Committee and was the chairman of SAS of ICAI for the year 2010-11. And I'm sure that is a vice chairman of Financial Reporting Review Board of 2021. And he is always a backbone of Kannur branch, and wherever the Kannur branch, any program is there, Babu sir will be there without any hesitation. He will always accept our invitation. So I'm taking this opportunity to welcome Babu sir to this virtual CP seminar of Kannur branch. Babu sir, once again welcoming and thank for all the support extended to Kannur branch and the entire Kerala. Regarding MP Vijayakukar sir, our own MPV sir, I have no words to say. Yes, he is the icon of our profession. Apart from his professional excellence, I am always passionate on his simplicity and humbleness. Now chartered accountant, not only in India, but in the entire world, will never miss an opportunity to hear from the great professional MPV sir. And any chance, nobody will miss any chance to interact with this great professional, our own guru, MPV sir. Irrespective of the seniority, I'm sure that one or the other way, he is the guru of all the chartered accountants present here. And I am sure that all of us will get an excellent opportunity to clarify whatever may be the concern on the topic, the common non-compliance of accounting and auditing standards. And I am sure that MPV sir will definitely elaborate the consequences of such non-compliances as far as the Companies Act and other regulatory compliance or statutory compliance. Sir, I am taking this opportunity to welcome you to this 31st virtual CP seminar of Kannur branch, sir. And I am extremely thankful for your great support to the small branch that is our own Kannur branch, sir. I am welcoming all the members present here to this virtual CP seminar and extending our sincere gratitude for your great support to the Kannur branch. Now, I'm sure that no introduction is required for Babu sir, because this is the third or fourth time on the same platform Babu sir is here. And always Babu sir, whenever I am reading the data, he is always saying that JP, please don't stop, because everybody knows and he is one among us. And with his permission, I am requesting Reggie to formally introduce the faculty, our own MPV sir. Reggie, please.
Respected Chairman, C.A. Jayaprakash, beloved Central Council member from Kerala, Babu Abhraham Kallivayal sir, renowned speaker and leader of the profession and Central Council member, C.A. MP Vijayakukar sir, Secretary of the branch, Shivaprasad sir, illustrious past chairman of Kannur branch, my managing committee members, fellow members in the profession, students, and my dear friends, a very good afternoon to all of you. It's my proud privilege and great honor to introduce a very outstanding and eminent professional, CA MB Vijayakukar sir. CA Vijayakukar MP has over 27 years of experience in industry and as a chartered accountant in practice. He is a member of the Central Council of the Institute of Chartered Accountants of India for the period 2016 to 2022. He was the chairman of Valuation Standards Board and Digital Accounting and Assurance Board, and presently the chairman of Accounting Standards Board. He was the vice chairman of Financial Review Reporting Board and Committee on Accounting Standards for Local Bodies, and presently the vice chairman of Expert Advisory Committee. He is a nominee member of SAFA Committee on Accounting Standards and was a nominee member of National Financial Reporting Authority, Quality Review Board, and SEBI Committee on Disclosures and Accounting Standards. And he is a member of various committees constituted by our institute, including Auditing and Assurance Standards Board, Board of Studies, Corporate Laws and Corporate Governance Committee, Ethical Standards Board, Internal Audit Standards Board, International Affairs Committee, Research Committee, Management Committee, Executive Committee, etc. He is a regular resource person for professionals on subjects accounting standards, IFRS, auditing standards, code of ethics, corporate law, governance, and capital markets. And he is a teacher for over 20 years on subjects of accounting, financial reporting, and corporate law. He is presently a member of IFRS Advisory Council for the period 2019 to 2021. He has association with Confederation of Indian Industry, Board of Governors, Madras Chapter, Life Fellow Member of Institute of Directors, Member Board of Studies, ICT Academy, and Member Regional Council of NASCOM. He authored 10 popular titles with extensive readership and continuous reprints for over 15 years. Dear members, this is a very brief extract of the profile of the eminent speaker, Vijayakukar sir, a man engaged with passion, a pragmatic envisioner, and a proven executor. Sir, we are extremely happy and delighted to have you for today's virtual seminar. Thank you, sir.
Thank you, Reggie, for your nice introduction of our MPV sir. Now I request Babu sir, please address our members and elaborate about the topic, please.
Yeah, distinguished speaker of the day and the eminent chairman of the Accounting Standard Board of the Institute of Chartered Accountants of India, who carries the reputation of the profession and the institute beyond the borders of the country by representing the International Accounting Standard Board, IFRS Committee, and so on and so forth. And I think chairman has got the best speaker available in the country on a topic on commonly found non-compliances in financial statements, because most of the non-compliances in the financial statements are related to accounting standards. And MBVSR is considered to be a walking encyclopedia on accounting standards. And therefore, and more so, I am deeply obliged to MBVSR because he is supporting me as a vice chairman of the Expert Advisory Committee, where I happen to be the chairman. And one thing I realized, I cannot run that committee without the support of the vice chairman. And this was a similar case when I was a chairman of the Financial Reporting Review Board too, because somehow we find that in technical committees, the support level is not adequate. And people like MBVSR take genuine interest in the deliberations in technical committees like Accounting Standard Board, Auditing and Assurance Standard Board, Expert Advisory Committee, Financial Reporting Review Board, etc. See, in the institute and the chairman of the branch, very dynamic, Jay Prakash, he is very fondly called as JP. JPs are all famous and ably supported by the charming secretary Reggie and other members of the managing committee, Shiva Prasad. I see a lot of past chairmen in the screen and very dear members of the Kannur branch. See, at the Institute of Chartered Accountants of India, our endeavor is to bring in best transparency in the financial reporting and to ensure the highest quality. And for that, Institute has devised few mechanisms. One is a peer review board. As all of us know, many of you would have undergone peer review. Second is a quality review board. It is a formal mechanism set up by the government of India, but practically run through the institute, through its able support. The fundamental difference between peer review and quality review is peer review looks into the overall functioning of a chartered accountant's office and the audit quality of various sectors, whether it is a company, limited company audit, listed company audit, not-for-profit company, profit organization audit, your tax audit, everything they look into that. Whereas in the case of quality review board, they select only one audit file, generally an audit file of a listed entity, which is being selected by them and go threadbare. Therefore, I've been subjected to quality review. Therefore, I know what is I can only tell you that it's a tough task. And the peer review report goes to the peer review board, and generally they give you opportunity to rectify the deficiencies before the peer reviewer issues the final report, or even the final report is issued, still they will require you to rectify the deficiencies. Whereas in the case of quality review board, they don't give you an opportunity for you to rectify the deficiencies once the reviewer submits its report. And another mechanism is financial reporting review board. Financial reporting review board so moto selects based on certain prefixed criteria. The financial statements are largely available in the public domain and goes for the review. And at financial review board generally looks into the deficiencies or non-compliance in accounting standards, standards on auditing, largely reporting requirements under the Companies Act like Schedule 2 and 3, CARO, and other regulatory requirements. And I can tell you the highest non-compliance is on the Companies Act requirement. Out of the total reviews, 80 total non-compliances, 18% goes to non-compliances under the Companies Act. That shows that if you are doing a company audit, our awareness level on the requirements of the Companies Act is paramount. And then it comes to accounting standards. And I'm very surprised. AS3 on cash flow has a highest non-compliances in the category of accounting standards, with 8.1% of the total non-compliances is on AS3. I can share you my general experience. Many of the auditors do lot of emphasis on the balance sheet and the profit and loss account and the auditor's report, but somehow they don't give the due care what is required in the case of cash flow. And because of that, lot of non-compliances happens in the case of AS3 on account on cash flow. And another one is on employee benefit on AS15. 7.3% is on AS 15. And next is, as I said, Karu. 7.6% of the non-compliances pertains to cash flow. At FRRB, if you see the Institute Journal, they publish periodically on the issues came under review, and they also come out with periodical publications. So far, they have come out with 3 publications on the commonly found non-compliances, and these publications are available for a free download. The publication is named as a study on compliance of financial reporting requirements. Volume 3 is the latest one, and we are planning to come out with the volume 4 largely on Ind AS. The volume 3 is on accounting standards. Therefore, volume 4 is in the pipeline. I am sure 2020 it will see the light of the day. Therefore, at financial FRRB, there are 3 consequences. If the compliances found are not very serious, we issue an advisory in the nature of a warning to the member, saying that these are the non-compliances which we found during the review, and if there are no serious observation, we close it without any communication to the member. And if there are serious deficiencies are found, these cases are referred to disciplinary action. During when I was a chairman of the Financial Review Board, we have reviewed 91 cases. Out of that, 11 cases were referred to disciplinary committee for further action. And if there are other serious non-compliances which is beyond the purview of the institute, we refer it to the concerned regulator, whether it is Ministry of Corporate Affairs, whether it is Reserve Bank of India, whether it is SEBI, and so on and so forth. Therefore, why all this is being done is to ensure because ICAI is a regulator of the accounting and auditing profession in the country, and we are dedicated towards promotion of best financial reporting practices in the country. And the objective is to ensure sound financial reporting practices and transparency in the financial statements, safeguarding the interests of the stakeholders. Therefore, my kind request to my honorable members, if you are doing the audit of a private company or a public company, kindly download the FRRB publications on commonly found non-compliances. It will be of immense use. And I am sure today's MB Visa's presentation will give you a bird's eye view on some of the non-compliances which you yourself review your financial statements audited by you. You will find that some of these non-compliances are persisting in our own financial statements. Therefore, that is not a very encouraging situation. Therefore, I re-emphasize that today's session is one of the very important sessions for all of us who, if we are doing an audit of a company, or even for non-corporates also. Therefore, I wish this seminar all the very best. Once again, yesterday, both MBV sir and myself were together in another webinar organized by another forum of Chartered Accountants, Toastmasters Club, CS Toastmasters Club of Ernakulam, where MBV sir was a keynote speaker and the chief guest. And today also he has, therefore, despite his hectic schedule, what I mean to say that he is available to the branches and members. I once again thank MBV sir for joining and the branch for inviting me. Thank you very much.
Thank you, Babu sir, for enlightening and cautioning our members regarding the various non-compliances and the statistics that you have provided on the non-compliance, especially AS3, AS15, CARO. And I'm sure that this session will definitely contribute to reduce the percentage of non-compliance, and the members will definitely go through FRRB publication for the value addition to the profession of the chartered accountancy and the financial statements. Thank you, Babu sir, once again. Now I request MPV sir to take over the forum. MPV sir. Over to
Thank you,
MPV sir.
JP. Thank you, JP, for the invite. At the outset, my very sincere thanks to Babu sir for all those very kind words which he has shared. In fact, personally for me, this is the 5th year at the council, and the kind of guidance he has given me right from the first year has helped me learn. He's literally 26 years of association with the institute activities. At the branch, a long stint, which is one of the largest branches in the country, followed by the regional council another 9 years, and now at the central council. The way he handheld me and guided me through the functioning of the institute, as I'm ever thankful to him forever. And more importantly, the way he chairs the meetings and allows people to deliberate and is not in a hurry to conclude. I think that's been one of the big traits I have picked up from him. And thank you, Babu sir, for your amazing contribution to the profession. Thank you on behalf of everyone present here. It's not easy for someone to give this quantum and quality of time to the profession. It's not a easy one. You have done it, and you inspire a lot to contribute more to the cause of the profession. Thank you, sir. Sincere thanks to Reggie for that warm introduction. My thanks to the managing committee members for having invited me here today. Past chairman of the branch, senior members of the profession, and fellow professional colleagues, greetings to all. I trust all of you are safe and all your near and dear healthy. I will get straight into the presentation of these non-compliances. I'll try to leave about 15 minutes in the end so that we can have some Q&A, some interaction. I may not be able to run through the whole slide deck, but the whatever coverage I do will give you a sense of how the remaining slides have to be read through later. So I'll share a copy of this with JP. I'll share a copy with JP. Now, just a small disclaimer. This particular presentation and whatever views I would share, none of these views should be seen as views of the council or any of the committees or boards which I am part of. We have some non-compliances on standards or auditing, some on accounting standards, some on CARO. It's a fairly exhaustive list. What we have in this slide deck is a limited list. It's a very limited list. Otherwise, as Babu sir mentioned, there are three full volumes of non-compliances which have been listed down. And as he mentioned, I would strongly encourage everyone doing company audit, including private company audit. I would encourage that the publication of non-compliances be downloaded and some weekly training program over the next 6 months be done within the staff so that the staff can be equipped to avoid these non-compliances. In fact, when I take you through the non-compliances, many of you will be surprised. Will somebody ever make this kind of mistake? In fact, none of us will believe that people can actually make this kind of mistakes. In fact, all these non-compliances are for listed companies and large companies. Imagine for listed companies, large public interest entities, if this is the kind of non-compliances which are there, you extrapolate it to a larger population and see what it means to the profession. All of us want the profession to be a very respectable profession the respect and stature of proportion is directly proportionate to the quality of the work which is experienced by the various stakeholders, including the regulators. So it's all about the quality of work. In fact, Babu sir was mentioning yesterday evening that the chain is as strong as the weakest link in the chain. Same is true with the profession as well. Unless the whole profession breeds quality, the profession cannot gain that kind of respect which all of us aspire for. And these programs are largely in the direction of ensuring that we build that overall capacity. As far as financial statements are concerned, I have this just from a context setting point of view, I've always believed that accounting is about accountability. So when as preparers of financial statements or as auditors of financial statements, it's an accountant function and it has to come with lots of accountability. And accounting is the base for whether it's tax calculation, investments to come in, or bank credit, sustenance of organizations or governance. In fact, some of the statistics on IBC cases is scaring. You had auditors signing previous year that everything is fine, and within 7 months, the company has gone into IBC. Banks had to take a haircut of 65%, 70%, 80%. So there are very serious questions being asked as to when the previous financial statements were signed, going concern assumption was accepted, no asset impairments were done. What was the auditor's basis of doing all that? And how did this change happen? And there is so much of haircuts which the banks had to take, which is all public money. It's all public money. So when public get lesser interest on rate of deposit, they get lesser interest because this amount is used for bearing all of these losses. And lastly, since most of us here in the call today are auditors, and when we express an audit opinion, we need to recognize that every opinion we express is a communication. And just like individually, personally, you and I would like communication to be truthful and complete. When it comes to audit report also, the users of our audit report, it can be a bank who is lending money on that basis, or investor investing money on that basis. They all expect that the communication should be truthful and complete from our end as well. Just, I'll not read through all the 14 points, but I'll just highlight 2-3 important points to set the context of why this non-compliances understanding is so very important. As far as audit standards are concerned, in the past, they were all issued under the Institute Act and binding on members. But now standards on auditing is the law. It is all notified under the Companies Act. And with the requirements around certification on IFC, fraud reporting directly to government and all, the auditors need to exercise much more vigil than in the past. You're all aware that we have the new code of ethics also, which has hit the road from July 2020. And from an audit opinion point of view, it is important for all of us to recognize that we as auditors have been empowered a lot. We have been empowered a lot, and we are now allowed to be vocal. In our audit report, we are allowed to be vocal. About 10 years back, audit reports were largely a template. But now SA 706 talks about emphasis of matters, other matters. So as an auditor, when you express an opinion, and if you believe there are some points on which you want to give higher emphasis or bring other matters to the attention of the readers, that power is given to the auditor in SA 706. So your audit report is not a template. It is very client specific and you share the information. SA 701, key audit matters. This particular standard mandatory for listed companies, but for others, including private limited companies, you can voluntarily follow. And I would encourage you to follow. What SA 701 says is, in the performance of audit, there could be 2 or 3 areas which you believe are so important areas, be it with reference to receivables, inventory, revenue recognition, litigations. So those important areas, you list down in your audit report and tell that, I believe these are 3 important areas for this reasons. And these areas I performed audit in so and so manner and I satisfied myself. That is SA 701. So you describe the work which you have done. Similarly, we now have CARO 2020, which is coming from the financial year 2021 onwards. That is the current financial year onwards. Unlike the previous CARO, this CARO has about 47 elements essentially to report, 47 elements to report, and it is a fairly exhaustive report. I'll give you one small example of a clause, and I'm sure most of your clients will fit in this category. If you have working capital borrowings above 5 crores, in CARO, you are required to report that the stock statements filed with the bank during the year are tallying with the books of account. Just think of how difficult it is. And as an auditor, next June, July, August, we all have to sign this, saying that in the last 12 months, the stock statements filed with the banks are all tallying with the books of account. I'd request JP and his team to organize at least 3 to 4 programs on CARO 2020 in the next 5-6 months. I would like you to sensitize all your clients and let the clients be ready about this kind of exhaustive reporting which will happen next year. It's not a small reporting, it's quite exhaustive. Similarly, there are several other aspects which have increased the focus on the audit profession. So let me now come to common non-compliances relating to auditing. As far as this non-compliance are concerned, as I told you, it's an illustrative one. So I'll cover a limited number of the non-compliances. 2 standards. One is the reporting standard, SA 700. Another is the standard relating to audit evidence, SA 500. As far as SA 700 goes, please note, as I told earlier, each of these observations are related to listed companies, large public interest entities, and many occasions, they're fairly large audit firms too. First of the observations, here is an audit report where the person has not quoted the firm's number, FRN number has not been quoted. The second observation is, just look at that red font one. Audit report which has been given here. The person has copy pasted verbatim. In the case of profit and loss account, of the profit stroke loss for the year. So from the SA 700, the auditor has copied the format as it is. So profit or loss. So despite the fact that for this year, it is either profit or loss, it put this copy paste as it is. The point to note is even the 2-page audit report, the auditors who sign do not spend time in reading and signing. Imagine all these are in the public domain with the MCA and all. And we keep going to MCA talking about our profession contribution and all. And they put across this kind of quality of work before us. So somebody even signing the 2 pages does not read the 2 pages before he or she signs. Imagine if the same mistake was done by a CA final student. I'm sure the answer would have been struck off, no marks awarded, probably has tried the next exam. But here somebody for remuneration is signing an audit report and issuing it audit report under law. Third case of SA 700, the auditor has issued a report without the headings in the audit report, like management responsibility, auditor responsibility, opinion. So no headings were given. So that's another non-compliance. And please note, these are not isolated non-compliances, not like one-off cases. If they are finding place in the slide deck, it means there are many cases of such non-compliances which are there. That is where they have come here as common non-compliances, which means they have come many times they have come. That is why they are finding place in the slide deck. It's not a one-off one. The next case is the audit report says that you have complied with accounting standards, but when we did the review, it is observed that there is non-compliance with several standards. Several standards have not been complied. Whether it is AS3, 10, 12 and all, several standards have not been complied with. This is another non-compliance. Just look at the dark font itself. The heading says auditor's responsibility and the paragraph reads, in our opinion. So the 2-page report, also people are not able to spend time, see and sign. Heading is auditor's responsibility and you actually give your opinion below that, in our opinion. Next. This is for a bank, and bank, you know, you have this central statutory auditors. They're supposed to be fairly large firms with big credentials and all. The audit report title was changed as report of independent auditor long back, but this person continued to give it as auditor's report. And this is a case of an audit report where the auditor has said, we have audited the accompanying financial statements which comprise balance sheet and P&L. He missed out cash flow. Cash flow statement is there in the financial statements, but in the audit report, when he gave his opinion, that cash flow statement sentence was missing. Then we have, in the case of another firm, in Caro, they just signed off saying that for and on behalf of the firm. So the institute requirements are, they should be signed by an auditor and he has to take personal responsibility and his membership number needs to be quoted. But that wasn't done. He just put it as for and on behalf of the firm. This is another non-compliance in SA 700. Again, very casual. Just look at the word which is there in red font. We have audited the attached balance sheet and the relative P&L. So related P&L, relative P&L. So person has not even spent time to that extent. Then SA 500 audit evidence. As far as related party disclosures are concerned, this particular auditor, the annual report has a paragraph which says, related parties and transactions have been identified based on information available with the company, and same has been relied upon by the auditor. You cannot rely on company information. As an auditor, you are required to do your independent audit procedures, satisfy yourself that all the related parties and the related disclosures have been made in full. You cannot give a statement that I relied on whatever was given by the company. Now let's spend some time on the common non-compliances of accounting standards. To begin with, on accounting standard 1, this is again a very large listed company. It says the accounting policy of the company is that the unrealized loss on the derivative contracts has not been recognized in books, considering principle of prudence. Just look at it. Loss not recognized, considering principle of prudence. We are all aware that unrealized gains should not be recognized on the basis of prudence, but every known loss has to be provided for in full. This is yet another non-compliance, where a company's accounting policy says subsidies by the government for providing telecom services in rural areas are recognized as other operating income in accordance with the relevant terms and conditions of the scheme and arrangements. You cannot have an accounting policy like this. For accounting for subsidies, we have a specific requirement that the accounting policy needs to be clear, and you have AS 12, which talks about when to recognize a government grant. No uncertainty in ultimate collection, no uncertainty in amount, then you need to recognize. So you cannot recognize as per the terms of the scheme and all. You should recognize subject to fulfilling those two conditions, and the policy needs to be drafted with more clarity so that people can connect that this grant has been recognized properly. This is another case of non-compliance of AS1. It says the accounting policy on revenue recognition is accrual. Company is engaged in the business of transmission of power, and in case of the tariff orders which are pending notification, then accounting is done on provisional basis as per tariff norms. So AS9 read with AS1 do not allow you to recognize such provisional one. You can recognize if there is no uncertainty of amount, no uncertainty of collection, and the services have been rendered. Consequently, this accounting policy has also been found to be inadequate. Disclosure of accounting policies. Many companies omit to give accounting policies on matters like borrowing cost, inventory valuation, very surprisingly, investments, employee benefits, taxes on income, impairment of assets, etc. I would like to draw the attention of all of you to two important documents of the Institute and I would request you to download the same and share it with your staff. Share it with your staff so that the staff can prepare. My view, most cases, the quality is based on how good the staff work is done. The two documents are a document called Quick Referencer on accounting standards. This document is only 40 pages A4 size. A4 size, it's only 40 pages. All the 27 accounting standards have been shrunk and very briefly explained, which is more than enough for doing small audits. There's a book available in the Institute ASB website called Quick Referencer. Similarly, there is also a publication called Disclosure Checklist, which we update every year. So that also can be downloaded. And for every client, you can ask your staff to tick checkbox whether the disclosure checklist have been followed with. In fact, for the staff, particularly article students, once they start doing it, it will help them for their examinations as well. So both these publications are available. Similarly, there is 20-minute videos in Digital Learning Hub platform. For each accounting standard, exactly 20 minutes. One video of 20 minutes for each standard is available. I'd request that you encourage your staff to go through these videos over the next 4 or 5 months and build needful skill sets. Coming back here, AS2 on valuation of inventories. As far as inventory valuation is concerned, you are required to, when you give your accounting policy, there are some companies who miss out to give a policy. There are some companies who miss out the word net. That net they miss out, sometimes it can be by design. Sometimes it can be by design. Lower of cost and NRV. Many organizations will have a pressure. If the NRV is below cost, you should recognize the loss. So realizable value may be above cost, but NRV may be below cost. So when people remove the word net, sometimes it is not by oversight. Sometimes it's just to communicate that I've been smart enough and I disclosed correctly how I have valued it. So standard is a very specific requirement that inventory should be valued only at lower of cost and NRV. And cost formula needs to be disclosed, whether it is FIFO or weighted average, specific identification method, the cost formula needs to be disclosed. In the case of a construction company, the unsold flats, unsold parts, they are all part of your inventory. So this inventory, they are valued at cost less depreciation, construction company, which is not allowed, If a construction company is unable to sell, it means there is lack of demand for the property or the unsold apartments or unsold units. And those unsold units, for which there is no demand, most likely it is less than cost. NRV is less than cost. So you cannot have an accounting policy that the unsold apartments, unsold units, I'll carry it at cost less depreciation. That policy is not allowed. Then there are a few cases where customs, the accounting policy of inventory, they say that customs duty is payable on clearing of goods and hence they have not accounted. The standard is very clear. Paying customs duty is on clearing of goods, but the liability is accrued. So you should add it to the value of inventory and show it as a liability. It may not have impact on P&L, but the inventory value will go up and the liability value will also go up. So on clearing goods, what you do is a payment, but your accounting liability has started already and you need to account on accrual. Accounting standard 3 on cash flow statement. As far as cash flow statement is concerned, most of the organizations who have imports or exports, they will have exchange gains. Exchange gains, some of which are realized, some of which is unrealized. Realized means I've collected the dollars or paid the dollars. Unrealized is on the balance sheet date, there is $500,000 receivable, there is $200,000 payable, balance sheet date, mark to market. So that unrealized gains or losses is not a cash flow. So when you prepare cash flow statement, you should remove those unrealized gains and then do your cash flow statement. Many cases, people don't do that and prepare the cash flow statement. Another significant difference is the cash and cash equivalents figure in the cash flow statement and the balance sheet. Between the two, it is important to do a reconciliation, and AS3 specifically requires a reconciliation of the same. Many people don't do the same. Now coming to accounting standard 4, as far as accounting standard 4 is concerned, which deals with events after balance sheet date. So in this case of a client or a company, their company's policy says they take into account the impact of any significant event that occurs after balance sheet date, but before the date of finalization of the accounts. Just please give me a second. Please give me a second. I'll sorry. So here is a case where the notes to accounts, it uses the word but before finalization of accounts. Finalization of accounts is a casual expression. Finalization of accounts is a colloquial expression. There is no such expression called finalization of accounts in AS4. In AS4, it is after balance sheet date up to the date of approval of accounts by the board of directors or the other governing body, as the case may be. So this is another common error. In AS5, the accounting policy reads as follows: prior period expense and income are included in the respective heads of expenses and income in the P&L account. AS5 has a very specific requirement that you have to either show prior period items below the line, that is after PAT, after current year PAT, or if you include in the respective heads of account, then in the notes to financial statements, you should disclose that so-and-so expense includes so much prior period item. So-and-so income includes so much prior period item. That needs to be given. Next comes A7. In A7, construction contracts, This is an accounting policy of a large company. It reads, job work revenue is accounted on the basis of running bills raised and approved by the clients. Now, as far as construction contract is concerned, the revenue should be recognized based on percentage of work completed, not based on the bills raised. So how much is the percentage of work completed? There are several methods to derive that. There is a survey method, there's cost to total cost method, there's a physical completion method, there's different methods prescribed in the standard. So you cannot recognize revenue based on running bills and what is approved by clients. It has to be based on the percentage of completion only. Similarly, another instance of AS7, the company is involved in construction business and its schedule of inventory also include an item of job in progress, which means construction work is in progress, and AS7 has specific disclosure requirements. Wherever there is construction work in progress, you should disclose how much is the cost incurred till date and profits recognized, how much is the advances which have been received for the contract, how much is the retention money. All these disclosure requirements are to be given. And they have shown it as part of inventory, whereas it should be shown separately as part of your construction work in progress. Now comes AS9, revenue recognition. On revenue recognition, one of the common non-compliances is inter-division transfer of goods is also shown as revenue. So if a company has 3 divisions A, B, C, whatever division A is selling to division B, they show it as a sale, also show it as a cost. Effectively, profit does not change, but the sales figure will get boosted. Profit will not change, but sales figure will look larger. And typically you tell it's a 200 crore company, 300 crore company. But if this includes interdivisional sales, that is erroneous reporting. So interdivisional income cannot be recognized. Another case of non-compliance in AS9. Here revenue from sale of products is inclusive of excise and export incentives. As all of you are aware, as far as excise is concerned, this is the pre-GST era. Excise is concerned, you had to show revenue as gross less excise duty. That was the presentation requirement. And export incentives is not revenue. That needs to be shown separately as other operating income. AS11, effect of changes in exchange rates. This is again a very common non-compliance where the accounting policy, read that red color font. Sales include realized exchange fluctuation on exports. So exchange fluctuation on exports, that should go as other income. It should not be added to sales. Similarly on imports also, exchange differences should not be adjusted to purchase figures. So whether sales or purchases, export or import, we should initially translate at a particular rate, and with that it is final. Any exchange rate movement after that, that should be recognized only separately. This is another instance. An accounting policy on foreign currency transactions states that on purchase of goods, we are translating at the rate prevailing at the time of settlement of the transactions. That is not allowed. The exchange rate should be on the date on which you are purchasing the goods, the date on which you are receiving the service. Settlement is a different activity altogether. And that difference will be an exchange difference to be shown separately. So this accounting policy is also an erroneous policy. Here is another instance of AS11 non-compliance, which says current assets and liabilities denominated in foreign currency as at balance sheet date are converted at exchange rate prevailing on balance sheet date, except in case of short-term loans. So, as far as short-term loans are concerned, they are all in the language of AS11, what we call as monetary items. Anything which is receivable in money or payable in money is called monetary item. All monetary items should be translated at the balance sheet exchange rate. All monetary items. Whether you have those cases, whether it is a loan receivable or payable, as long as it is receivable or payable in cash. AS13, accounting for investments. This is a very common mistake. Many companies have some investments in their balance sheet, 3 lakhs, 5 lakh, 20 lakh, 50 lakh, some investments. And these investments are usually long-term. Sometimes some group company, family concern, some investments are there. All long-term investments are to be carried at cost. Please give me a second. Please give me. Sorry. So coming back to this AS13, this is a very common non-compliance which is there. Long-term investments, AS13 requires to be valued at cost, and AS13 provides that if there is a fall in value, of investments which is other than temporary, then provision should be made for the losses. But in practice, many annual reports, they write like what you are seeing on the screen, red font. Provision is made for any permanent diminution. That is not the language of the standard. I would strongly urge every accounting policy, I would request that you stick to the language of the standard. In the standard, every word is actually debated, including a punctuation, a comma is also debated. So my request, there's a difference between permanent diminution and diminution which is other than temporary. There's a difference between the two. So on the face of it, it might look like similar, but they're quite different. And this kind of a drafting is not allowed. Similarly, There are cases where companies have invested in various units, bonds and all. We all know that every company, some bonds, etc. are invested either because the bank with which you are banking, they have issued some bonds, they have requested you to buy goodwill gesture, you bought 2 lakhs, 5 lakhs, some bonds have been bought, or to give it as lien for some statutory authorities, some bonds, etc. you are carrying. So many organizations have some investments or the other, but they miss out on that accounting policy. Next, again on AS 13, it is observed that in the schedule of other income, certain profits of sale of investments have been included. As far as AS 13 is concerned, there's a very clear requirement that wherever there's a profit on sale of investments, that profit on sale of investment should be disclosed separately. You cannot include it under something else. You can have a schedule other income, and in that you can have a breakup and give. That is perfect. That is perfect. But you should disclose in an identifiable manner profit or loss on sale of your investments. AS 15, employee benefits. Here is a company, again a large listed company. Just look at the language, how much casual somebody is. Just look at it, how casual somebody is. Annual contributions in respect of PF are made to LIC of India and are accounted on accrual basis. All of us know PF, it is typically a state contribution. LIC policies are typically for your gratuity. And secondly, the LIC premium which you pay, that is not expense for P&L. LIC premium is funding of your liability. The expense for P&L should be determined by following an actuarial valuation. Less than 50 employees, some exemptions are there in measurement, but otherwise you have to measure following actuarial method and based on actuarial valuation. Suppose my liability comes to 70,000 and insurance premium is 65,000. So P&L will be debited for 70,000 and in my balance sheet I'll carry 5,000 as liability because I paid LIC only 65,000. There can be an opposite scenario also. Actual value is 70,000, but LIC premium is 72,000. Then difference 2,000 will be shown as a prepaid asset. So AS 15, very, very common mistake. People debit insurance premium amount as an expense to P&L. That is wrong. That is wrong. That is wrong. Insurance premium is funding of a liability. How much is expense and liability? You have to determine only through a actuarial mechanism. Next. AS 15, another instance, the company's accounting policy states provision for gratuity is made in accounts considering balance sheet date as the notional date of retirement. What this organization does is it assumes all the 300 employees, if they retire on 31st March, how much I should pay. Based on that, gratuity is provided. But standard does not allow that. And please note, standards are all notified under Companies Act, which means they are law. Law does not allow that. So wherever you have more than 50 employees, you have to necessarily do an actuarial valuation. Actuarial valuation means estimate of how many employees will fulfill the conditions, how many employees will work for what length of period, based on which you determine what is the likely liability. So there's a methodology for that called projected unit credit method, and based on that method it needs to be calculated. So we cannot follow what this company has done, where they have said we have calculated based on balance sheet date, assuming everybody is retiring on that date. Next, another instance of AS 15 non-compliance. Accounting policy on termination of benefits for this company says that the VRS pay scheme are recognized in P&L in the year in which payment is effected. So you cannot follow this policy. Suppose I have announced VRS in 1920 financial year, 1920, and 60 employees have accepted. I may pay partly in 1920, partly 2021, partly later. That is payment. But my obligation to pay has commenced immediately. So VRS announced in 1920, 60 employees have accepted. The moment they have accepted, my obligation starts. So I should recognize the full expense and create a liability. Payment can happen whenever. So you cannot account VRS based on the timing of payment. There are few companies where we have come across where they do not provide accounting policy on employee benefit plans. They don't make the disclosure requirements. Nothing on accounting policy is completely silent. So that's also a serious case of non-compliance. Look at this this case, again on AS 15. I'll read the policy of this company. Contribution to defined contribution schemes, such as Provident Fund, etc. I don't know what that etc. can be, are charged to P&L as and when incurred. In respect of certain employees who have not opted for pension benefits, PF contributions are made to a trust administered by the bank. You'd have got a hint that this accounting policy is for a bank. So bank is such a large public interest entity, and you know the kind of central statutory auditors you have, and look at what the accounting policy reads. It reads words like etc. and it says you charge to P&L as and when incurred. These are strictly not allowed. At the cost of repetition, I want to reiterate, whenever you draft accounting policy, please stick to the language of what is there in the accounting standard. The standard does not have these words called as and when incurred, etc. and all. Now, A16 on borrowing cost. A16 provides as follows. This entity, accounting policy of valuation of inventory, states that finished goods are valued at lower of cost or NRV, and that the cost includes depreciation, interest, and direct expenses. Now, as far as interest is concerned, all of you are aware, as per AS16, borrowing cost can be capitalized, can be included only if it takes a substantial period of time. So if the inventory production takes a substantial period of time, which is interpreted as 1 year, then you can include borrowing cost. In this case, the company we came across was a company with short operating cycle, and interest cannot be capitalized or included in the valuation of stock. Then, this is a case of omitting to disclose accounting policy company had borrowing costs. Some borrowing costs were also capitalized in the property, plant, equipment, but they did not give an accounting policy, which is a non-compliance. Another instance on AS16, borrowing costs. This is relating to debt restructuring charges or the external commercial borrowings, the upfront fees which is paid. The restructuring charges which have been paid to extinguish high cost debt were written off over the tenure of the fresh loans taken for financing such high cost debt. So in this case, what the company did is there were existing loans of 5,000 crores. That loan got restructured and replaced by a fresh loan. So in that restructuring process, whatever charges they incurred, that charges, they have taken an accounting policy to write off over the remaining tenor of the loan. That is not allowed because in a restructuring, existing loan is retired and a new loan comes in. So any charges relating to restructuring of existing debt has to be recognized as an expense immediately. Next, A17 segment reporting. Many organizations have some business segments, but they don't disclose the same and they don't give segment information. And in A17, we have a specific requirement that if you don't have multiple business segments, you should disclose saying that we are operating in only one segment. So which means you are making an assertive statement that you don't have any segments. And there are some cases where we have come across where, please give me a second, please give me a second. Yeah, sorry. Coming back to this one, my apologies. I had to take a few calls. Maybe another 15 minutes also, I'll take a couple of calls. There's some small domestic emergency which is there, which I need to address as well. And that's why I'm not able to avoid those calls. Father is returning from hospital, so I'm coordinating that parallelly. And since this was a prior commitment, I didn't want to cancel this commitment. I'm sorry about this breaks. So this is on A17. So one of the notes to accounts states that the company is primarily engaged in iron and steel products and that there are no reportable segments as per the standard. But in the management disclosure and analysis, MDNA, for SEBI purpose. For SEBI, all listed companies have to give what is called management discussion and analysis, where in that MDNA, they have both export sales and domestic sales. So A17 provides, you can have a single product, but if you are having exports and domestic, then the segment information of how much is your exports and how much is your domestic sales needs to be given, which was missed out in this particular company. Then AS18 related party disclosures. The related party disclosures have not been disclosed in financial statements, even though director's report showed that there is a managing director to whom remuneration is paid. This is a very, very, very common mistake we come across. In director's report, company will give information of managerial remuneration. Company will give information of performance of subsidiaries, joint ventures, associates. But in the financial statement, the same will be missing. For example, after the new Companies Act 2013, even if you are a small private limited company and you have a subsidiary, you have to prepare consolidated financial statements. Now, there are many cases where the companies have a subsidiary or associate and they disclose the same in the director's report. The director's report, they say that this is how our subsidiary is behaving, joint venture operations are. But they have not done consolidation. So they themselves conflict within the standard, within the financial annual report. And similarly, there are related party disclosures in the director's report, which similar disclosures should have come in AS18, which are also missed out. And I would like to highlight for benefit of all a very important audit standard. Everyone doing companies audit, I would request you to go through this audit standard because many miss out. There is a standard called SA 720. SA 720. For every company audit, SA 720 is mandatory, even if it's a private limited company. What SA 720 says is, if your annual report has other information, like director's report, whatever other information, as an auditor, I am supposed to ensure there is no conflict between what is there in director's report and what is there inside the financial statements. So that's an important disclosure requirement which is there. Then another disclosure requirement on AS18 related party disclosures. It was noticed that outstanding balances with fellow subsidiaries, other subsidiaries, should have been disclosed. There were transactions, but these amounts outstanding have not been disclosed. So that's an important disclosure requirement in AS18. Another instance, what I just mentioned a few minutes back. Company has told in its corporate governance report, listed company, that they have a joint venture. But in the financial statements, neither in investment schedule, nor in related parties, nor they have done consolidation. So corporate governance report sees it as joint venture, but the same is not captured in the financial statements anywhere. Next. Another instance of AS18, legal and professional charges include certain amount which is paid to a firm in which one of the directors is a partner. So notes to accounts has this disclosure, but the same disclosure should have also come as part of related party transactions, which was missed out. So which is also a non-compliance. Earnings per share, very common non-compliance. There are many companies who miss out to give EPS and where they give EPS, reconciliation of numerator and denominator is very important. And many cases, this numerator and denominator reconciliation is missing, which I just mentioned. That reconciliation of numerator and denominator is a very, very important requirement so that reader knows how the EPS figure has been computed. And the standard also requires reporting what is called diluted EPS. So company may have stock options, company may have convertible shares and all. So those are called potential equity shares. Whenever there is a possibility of new shares being issued, those cases, the EPS is likely to come down. That EPS is called diluted EPS. The standard has a requirement that if there is no potential equity shares, you should report how much is the potential equity, how much is the diluted EPS, and state that it is not applicable. If it is there, disclose it. If it is not there, you should mention that diluted EPS is not applicable. Then coming to AS 22, many companies do not disclose the breakup of deferred tax liability and deferred tax asset. On deferred tax, we all know deferred tax liability or asset is always made up of 3-4 items. Depreciation difference, 43B items difference, unabsorbed depreciation, etc. So those break up, you are required to give it in your notes to accounts. And in many, many cases, they don't give the same. Then another disclosure requirement, the accounting policy of this company says deferred tax liability and assets are recognized subject to consideration of prudence on timing difference using the tax rates substantively enacted on the balance sheet date. As far as this deferred tax asset is concerned, there are 2 categories of deferred tax asset. One is those which are routine items like 43B items. This year disallowed, but next year it will not be allowed. Those cases, you have to look at reasonable certainty and measure. Then there are deferred tax assets because of unabsorbed depreciation, carry forward business loss, where you are required to demonstrate what is called virtual certainty. Means beyond doubt, you have to demonstrate that you will be able to get the benefit of set off. So that needs to be brought out. So you cannot write a policy like this. You have to break your policy for deferred tax assets. Some categories come under reasonable certainty. Some categories come under virtual certainty. This is another instance of AS 22. Company had carry forward losses and its accounting policy reads as follows. Look at the red font. The management is of the opinion that sufficient future taxable income will be available against which such deferred tax assets will be realized. This kind of a policy is unacceptable. As I just told you, for all carry forward losses, you require a demonstration of what is called virtual certainty, and the nature of evidence supporting virtual certainty should also be given. So this kind of a sentence construction is not allowed. And at the cost of repetition, I want to highlight that accounting policies never draft on your own. Please ensure it sticks to the language of the standard. I want to highlight for the benefit of all of you 2 things now. With NFRA being formed and focusing on listed companies and large public interest entities. The Quality Review Board, which used to earlier deal with listed companies, has now started reviewing unlisted and private limited companies. So it can be a 50 crore company, 100 crore company and all. And when QRB reviews, it's a hot review. When QRB reviews, a reviewer with about 20 years experience of auditing that industry from a different region will come, spend 7 days, and he will be paid by the institute. He's paid a 6-digit figure, good figure, which figure is almost like a bank audit fee. He will come, spend 7 days, look at the entire audit working papers and form his opinion. So gone are the days to feel that I am doing my audit somewhere in some part of the country, nobody will catch me. There's a very randomized process of selection, and based on that, people will reach out. So all these things are extremely important now. Presentation of deferred taxes. There's a specific positioning of where deferred taxes should be given in the liability side and asset side. And as far as asset side, it should come after investments and above current assets. Here again, many companies, there has been non-compliances of its presentation. AS 23, accounting for investment in associates. As far as associates are concerned, I told you after 2013, even if it's a private limited company, 10 crore turnover, and you have a 30% shareholding in some group company, friends company, extended family company, that 30% shareholding is your associate. And AS 23 requires you to consolidate. So even for the private limited company, even if you have only associate, no subsidiary, small private limited company, you are still required to do the consolidation. And many cases, people have missed out on the same. Similarly, we have AS 24, which is a standard dealing with discontinuing operations. So where businesses are being given up, some business you are giving up, you are required to make a specific disclosure of the discontinuing operations to show the impact on P&L and balance sheet. In this example, the company gave up manufacturing of fertilizers and taken the real estate activities. So that particular case, they did not make these disclosures, which was held as a non-compliance. Similarly, AS 26 on intangible assets. Intangible assets, R&D, whatever we spend, specific disclosure is required of what is the amount spent on research and on development. The standard has a specific requirement. Many organizations, directors report, they will boast saying that we are doing research, we are doing this and all, they do. So directors report says we are doing research, but in P&L there is nothing called research expense. Recall I told SA 720, we are required to ensure both of them are tallying. So if there is any expenditure towards research, whether it is salaries, laboratory equipment, depreciation and all that needs to be identified and shown separately in the financial statements. Then intangible assets, brands and goodwill. Here is a company which is amortizing over a period of 20 years. AS 26 allows you to amortize over 10 years. If you are exceeding 10 years, AS 26 requires you to explain why you believe a higher period is essential. You have to give a strong reasoning of why the same is there. In this case, that was not visible. AS 27 joint venture, similar point like the associate. Here again, company, director report says we have joint venture. Related party information says we have joint venture, but they have not done consolidation. The moment you have joint venture, consolidation needs to be done, and that requirement is there in AS 27. A few non-compliances in CARO before I open the floor for discussion. In CARO, which is the erstwhile CARO, company has generally maintained proper records. So these kind of expressions are not allowed. Particularly new CARO, I don't know how many of you have seen it. New CARO, most of them, the answer is yes, no. This general English and all, those words will be completely gone. So you have to be extremely careful. And another instance of CARO, physical verification. As explained to us, it says, as explained to us, fixed assets are physically verified by management over a period of 3 years, which in our opinion is sizable. You cannot draft a para like this. You should be satisfied whether they are doing it over a period of 3 years. So management explained that will not help. You should see whether a program exists and whether the program is being followed. So that should be the language. So that was not there in this case. Similarly, another paragraph of CARO, it reads, according to information and explanation given to us, company has not taken. This given to us information, that will not help at all. That will not help at all. So as auditors, we need to do a complete review of the same. So with this, I will draw to a conclusion. I'd like to leave the floor open for discussing for a few minutes. So thank you all for your patient listening, and I sincerely apologize for the inconvenience in between, and happy to interact with you on questions. Over to you all.
Thank you very much, sir, for enlightening all our participants regarding the various non-compliance of auditing and accounting standard by traveling through, I think, all the entire accounting standard and specific to essays. And I am sure that even though we may feel that some of the non-compliance are not material on our first side, but I'm cautioning that the statutory looking on that will be very material. And if you are not concentrating on that, it may dilute the professional value also. Anyway, we may have to conclude within a short span because MP sir is also a little bit of some personal emergency. So I request if any question is there, please post your question or interact with the faculty very immediately. I think, sir, one question I can see in the chat box that came privately. Can I read, sir?
Please read.
Yes, sir. In respect of a company who had factory previously had closed down its manufacturing operations and now runs the business of trading goods. The vacant place at the factory premises now given on lease to various parties. The rental income contributes substantial revenue to the company. Whether this rental income should be considered as a separate segment as per accounting standard 17.
Okay. As far as this entity is concerned, you have to see based on your, okay, in AS17, there is what is called how the management views the business. Are they seeing leasing as a business, or is it other income because there is surplus land available? In the facts which you gave, it appears to be surplus land and it's given on rent. It is not an activity which you are carrying on as your main activity. Even though amount is substantial, it is not something which you are carrying on as an activity and reviewing at the board of directors level. Consequently, it is not required to make a disclosure.
Okay, sir. So another question, oh, that is this. Is it mandatory to use company audit report format to the urban cooperative banks also?
No, urban cooperative banks, they all come under the Cooperative Societies Act. So consequently, SA 700 format is same. SA 700 format is same. What will not apply is your CARO.
Okay, sir. Okay.
There is
So,
one question from Mr. Kumar Bhatt, which has come privately.
Yeah.
Some light on COVID-19 in audit. I'm very thankful that this question has been raised. A very important one. I'll take a couple of minutes. I noticed there are a good number of younger members here. As far as the financial year 19-20 is concerned, I'm sure for most of the private companies or even for non-corporate entities, you must be finalizing audit now. October and all, it must be in the process of getting finalized. While finalizing, one very important word of caution I have from my side is on going concern. I have seen 3 economic downturns in the past, but in the past, we have never had instance of testing for going concern. People somehow managed and came back. But this time, the impact is so sharp that every business, particularly small businesses, are very vulnerable. For example, the GDP is contracting by 10% on an annual basis. US, the quarter GDP was down by 32%. UK, the quarter GDP was down by 23%. When you have so much of contraction happening and the whole supply chain is affected, it is quite unlikely that our businesses and life will run normally. It's unlikely. Almost all businesses will be vulnerable. I would like to take the liberty, particularly for younger members, please don't get me wrong, a little bit of fatherly status, so I'll tell you this. Going concern assessment is not easy. It's extremely difficult. It requires understanding of world economy, Indian economy, the industry in which you are operating, the supply chain issues, and your own entity which you are operating. If you sign financial statements assuming going concern, within 3-4 months, the person decides to either voluntarily liquidate or go to IBC, you will be hauled up. You will be hauled up. So it's very important that take the support of some senior members who have seen it over a period of time. They can help you ask the right questions. On spreadsheet, every business is viable. On spreadsheet projections, every business is viable. But it requires that judgment capability as to whether this guy can survive next year or not. It can be a trading shop. It can be a cloth shop, trading shop. But that cloth shop itself, he may not be having enough working capital to survive. 5-6 months over, he may not be able to survive and he may have to close down. All these people have bank borrowings, 50 lakhs, 1 crore, 2 crore. And banks will be ruthless. When something goes wrong, they'll write to Institute for DC action. So in this COVID impact, one point you have to be extremely careful is about the going concern assessment. That's one point I would like to highlight. And around going concern, there is a lot of literature available already in public domain, what disclosures you have to make in notes to accounts so that you can protect yourself. So please take that precaution. That's one point I'd like to highlight. The second point I would like to highlight is for all of you here, thanks to this COVID, the professional opportunities will change dramatically. If you notice, reasonable number of audits you're actually doing without visiting your client place. Reasonable number, you have done it that way. Now, your client is in Kannur and you have not visited. The same client can be in Mangalore. I can still finalize. The same client can be in Bangalore. I can still finalize. Can be in Chennai and I can still finalize. So this COVID will open up completely different opportunities for all of you, and particularly in towns like Kannur, where you don't have to spend daily 3 hours or so on commutation. That much of time is additionally available. And my experience, members in towns have very deep knowledge of taxation, whether it's direct or indirect. They have very deep knowledge of taxation. Add to that some knowledge around FEMA, some knowledge around valuation, some additional knowledge around audit and all. The opportunities of addressing clients is much beyond Kannur. Earlier, probably you had to confine there, but now clients also are interacting digitally. Client is also not willing to come to your office. So it's all digital. So that's a huge transformation. And for all of you, if you have good tie-ups with firms in larger cities, including Bombay and all, good amount of work can be outsourced to you. Imagine a big established firm in Bombay with faceless assessment and all. If the drafting skills are good with me, the firm in Bombay will be more than happy to make available the file on a shared drive to you. You draft everything and go through the process, whether it is appeals, hearings, submissions, everything. There's nothing to go and represent. It's all about the quality of how you can draft and the in-depth subject knowledge of what case laws to quote and how to quote and things like that. So tremendous opportunities are on the way. I think while this pandemic will put us back in a sense, it's like tiger taking one step back and then pouncing. I think it's one step back and all of us should be able to bounce back very stronger. So these are a couple of thoughts around the COVID.
Thank you. I will take two more questions. After that, I will conclude, sir.
Please.
So one question that is came here privately. Due to COVID-19, there is no impairment of fixed asset, but only reduction of revenue for first couple of months. Please advise on the note to be given in the notes to accounts.
Okay. As far as impairment is concerned, impairment is a long-term view. Let's assume a small textile unit, small manufacturing unit. 2-3 months, no operations, unlikely to have an impairment. However, you have triggered what is called impairment indicator. So AS 28 says that whenever you have triggered an indicator, you have to do a test of impairment. Satisfy yourself no impairment. So the recommended note is to disclose, saying that there was an indicator which triggered impairment. Impairment test was done. No impairment was there, and hence no provision was done. That should be your reporting. And I want to caution, when it comes to impairment, many have this impression that I should judge based on 3 months activity, 4 months activity. No. Impairment is based on 5 years plus activity. So you will have this 1.5 years of low activity. Hopefully after that things will brighten up. So you should look at all those things. Considering all that, if you feel your written down value of assets is good enough, no impairment required. My view, if your depreciation policy is fairly conservative, you are unlikely to hit impairment for financial year 1920. But 2021, if you are not able to recover at all, there is a high possibility that there would be an impairment. Because if 2021 you have not recovered and one more year also will take time, there would be an impairment to be provided for.
Sir, another one is, could you please elaborate the capitalization of borrowing cost, where the ready-to-use period is compelled to extend due to COVID-19, even though the activities are going on in the, but not in the same phase.
Okay. There is a small document issued by Institute, 27th of March, FAQ, frequently asked questions because of this COVID. If your construction activity has stopped because of COVID, 3 months, 4 months, whatever, the borrowing cost during that period cannot be capitalized. It has to go only to P&L. Only to P&L. Capitalization can be done only when there is work happening on the asset and value getting added to the asset. If there is no work happening on the asset, borrowing cost will only go to P&L. And those cases you can give suitable disclosures so that reader will know the impact of these in your financial statement.
Right, sir. So I think the time is also 5 o'clock, and I know your emergency that your father is coming from hospital, and some logistic is to be arranged by you. Anyway, sir, thank you very much for your great support to the Kannur branch, and especially in this tight schedule. Now, to conclude, I request the Secretary of Kannur branch, CSO Prasad sir, to propose vote of thanks.
Chairman of Kannur branch, Chartered Accountant Jayaprakash, leaders of our profession, Central Council members of the Institute of Chartered Accountants of India, Chartered Accountant Babu Abhraham Kallivayal, and Chartered Accountant MP Vijayakukar, illustrious of Kannur branch, my dear colleagues, we consider this as a special day for us, a special day for the Kannur branch. We are blessed, we are happy with the gracious presence of two eminent chartered accountants having important role in leading our profession in the right way to greater heights. And we can rightly say as committed leaders in our professional fraternity. Both these Central Council members, CA Babu Abhraham Kallivayal and CA Vijayakukar from South India, believe that this profession have changed their life, and they work hard to give back to the profession, and they always stand for the betterment of our profession. We are very grateful to both of them. CA Babu Abhraham Kallivayal always guides us and supports us from the date of initiation of forming of our branch. He is well known to all of us. He has recently opened his beautifully renovated a new office in a great way. We offer him our wholehearted best wishes, and we are very grateful to him for being with us today. And of course, he is motivating us and for all sorts of help extended to us and to the branch. Thank you very much, sir. Service is service of our faculty and the Central Council office and Central Council member, CA Vijayakukar, is very, very praiseworthy. Especially to the younger chartered accountants, we understand that he not only teaches the subject, but also the life they should live. It is no doubt that is the topic common non-compliance of accounting and auditing standards is excellent. It is very useful to all the practicing chartered accountants and help to enrich our knowledge. We, the entire professional fraternity, regard our gratitude to CA Vijayakukar for being with us, for spending his valuable time, for sharing his knowledge, and for his excellent presentation. Thank you very much, sir. We look ahead your continued support and association with our branch, and at the same time, we wish you all the success in your endeavors. The leadership taken by our chairman, Jay Prakash, is marvelous, and he is very successful in organizing wonderful CPA programs. Thank you, Chairman C. Jay Prakash. We are very much thankful to all the participants, members, for your support and for your gracious presence in this seminar. Thank you. Take care. Be safe.
Thank you, sir. Thank you.
Thank you.
Thank you all once again. Thank you.
Thank you. Really, thank you. We are all blessed, sir. Thank you. Thank you.